Good afternoon, folks. Welcome to the weekly economic update for Monday, May 6th. May 6th, June 6th, 2022. Boy, just all messed up with my dates. So you can tell my boy Barney back there. He's really excited. You can see him over my shoulder over here. He's very excited about what's going on in the world. Hope everyone had a good weekend. Astros won 2 of 3. Not a bad series there in KC, and took I think 6 of 9 on their road trip. So that's certainly good news. All right, first time watching, be sure to give me a like, thumbs up, subscribe, all that good stuff. I would certainly appreciate you sharing the message of what's going on in the world. It means a lot. So, all right, first bit of news. Jim Cramer spoke on Friday last week. His tweet, I may be the only person besides Jay Powell, the Fed chair, who believes we are not going to have a recession. At least I hope Jay thinks that way. Wow, Jim, the most wrong man in finance is it's hilarious. I mean, all you have to do is watch his show, and you can probably go onto YouTube and find a bunch of wrong predictions on his part. So, anyways, that's what I wanted to show there. So, anyways, so in to quote C-3PO from Star Wars, we're doomed. So, we'll see if his prediction is right. I imagine you're probably better off betting against whatever Mr. Cramer says, just because he's kind of an idiot. So, all right, well, let's go ahead and jump in to see how the indexes did today. It was mostly a green day, but not a whole lot of lift on it, unfortunately. So, all right, the Dow Jones finished basically flat. It was up 0.05%. It's at 32,915. S&P 500 was up 0.31 at 4121. NASDAQ was up 0.4%, closed at 12,061. Small caps are up slightly, up 0.17. The VIX climbed, even though the market was up today. It was up 1.13%. It's currently sitting at 2507. Moving on to the other Americas. Let's see here. Canada was slightly up at up 0.14. Brazil down 0.82. Mexico down 1.25. Headed over to Western Europe. Germany was up 1.34. UK up 1%. France up 0.98. The Euro stock's up 1.14. Netherlands was up 1.59. Spain up 1.28. Italy up 1.65. Switzerland down 0.18. Portugal was up 0.82. Belgium up 0.98. And Austria up 0.83. The two Russian exchanges were down. The MOEX down 1.12. The RTSI down 1.75. Headed over to Asia. Japan was up 0.56. Australia down 0.45. New Zealand down 0.19. Looks like all of the Chinese markets were up. The Shanghai was up 1.28%. The SESE component up 2.66. China A50 up 1.62. And see here, the DJ Shanghai up 1.47. Hang Seng up 2.71. And the Taiwan weighted came in up 0.32. So it looks like it was a pretty strong day in the Chinese markets. And most of Europe looked pretty good. I mean, you had a few reds here or there, but most of them were up by 1% or more. The U.S. was pretty much the laggard, where stocks were up a lot more than where they were at the close. The Dow actually went into red territory during part of the afternoon. So again, we'll see where the long-term trend takes us, but certainly not anywhere good as far as what I'm seeing right now. So, all righty, well, let's go ahead and jump into the weekly economic update. All right, the week on Wall Street. In a holiday-shortened week of volatile trading, stocks surrendered some of their previous week's strong gains. The Dow Jones Industrial Average fell 0.94%, while the S&P 500 declined 1.2. The NASDAQ lost 0.98, and international slipped slightly, down 0.17. It's an uncertain market. Stocks experienced wild swings last week, in part due to ongoing uncertainty over economic health and the path of inflation. Investors seemed conflicted while interpreting the data. In some instances, viewing economic strength as negative since it may mean more aggressive rate hikes from the Fed. So these people are cheering for bad news so that the Fed won't raise rates much higher than what they're planning on. Illustrative of how this uncertainty has played out, stocks surged higher on Thursday despite comments from Fed Vice Chair Lael Brainerd indicating it's unlikely the Fed will pause on rate hikes. Then on Friday, stocks dropped as a better than expected jobs report raised concerns about monetary policy. Strong jobs growth. The U.S. economy added 390,000 jobs in May, a slowdown from recent months, but higher than consensus estimates. Job gains registered in several categories, led by leisure and hospitality, professional and business services, and warehousing and transportation. The retail sector lost jobs. The unemployment rate remained unchanged at 3.6%. Wage growth cooled off with a 12-month increase of 5.2, down from April's year-over-year jump of 5.5. Finally, the labor participation rate ticked higher again, reflecting higher job availability is helping to pull Americans off the labor market sidelines. All right, this week's economic data, pretty slow week. Thursday, we got jobless claims. Friday is the consumer price index and consumer sentiment. And just a handful of companies reporting earnings. Today on Monday, we have Coupa Software. Wednesday, we have Campbell Soup. Tasty. And Thursday, we got DocuSign. All right, well, that's everything for the weekly update. I do have two white paper today. And let's see, this first one is called Rehearsing for Retirement. All right. Imagine if you could preview your retirement in advance. In a sense, you can financially and mentally. You can, quote, rehearse for a third act of your life while still enjoying the second. Pretend you're retired for a month or two. Take two steps to act out your rehearsal, one having to do with your budget, the other with your expectations. Draw up a retirement budget and live on it for 1 or 2 or 3 months. Make a list of essential expenses, groceries, gas, utilities, mortgage, medicines, and then list of discretionary expenses such as movie tickets, dinners out, and spa treatments. Ooh, I love going to the spa. Not really. This may reveal that you can live handily or on less than you currently spend each month. Next, list your income sources for retirement. They might include Social Security benefits, retirement plans, pension checks, dividends, freelance or consulting payments, or other revenue streams. Investment income is also in the mix here, so check with a financial professional to determine a withdrawal rate from those accounts that you can safely maintain through your retirement. If you need someone to help you with that, I know somebody. Call me. It may be slightly different from the long recommended 4%. When you have your list, stack the projected total income against your essential expenses and see how much you have left over. Try living off that level of monthly income for a month or more while you're still working. If it covers your necessary monthly expenses and not much else, then some adjustments in your retirement strategy might be needed. A housing change, a change in your retirement date. See how it feels to retire. Before you conclude your career, try to arrange some previews of your retirement lifestyle. If you want to serve your community, volunteer avidly for a month or two to get a taste of what a daily volunteer work is like. If you see yourself traveling enthusiastically at the start of retirement, take a dream vacation or even a couple of consecutive trips, if your schedule allows, to see how you truly fit into your financial picture. Your rehearsal may not need to be last minute. If you think you'll retire at 65, you could try doing it at 63, 60, or even before then. The earlier you attempt, the more time you have to alter your retirement strategy if needed. What else should you consider as you rehearse? Basic income, expenses, and day-to-day retirement expense are a few other factors to gauge. How much cash do you have on hand? Starting in retirement with a strong cash position provides you with some insulation if you happen to retire during a market downturn. Kind of like what we're seeing right now. The possibility of a bear market coinciding with your entry into retirement may make you want to revisit your portfolio allocation as well. Take a second look at your projected monthly income. Will it be consistent? If it will vary, you will want to address that. If you are in line for a pension, you will face a major, likely irrevocable financial decision. Should it be single life? Should it be single life or joint and survivor? The latter option may reduce your pension income in retirement, but give your spouse 50% or more of your pension payments after you die. Your employer might also offer a lump sum pension buyout. If that turns out to be the case, you may want to consult with a financial professional who can help you decide if the lump sum constitutes a better deal versus a lifelong income stream. And that's something that I've dealt with quite a few retirees over the years. As far as, if you have the lump sum option, do you want to take the money and run, invest, drop it into things like an annuity or a bond ladder, or whatever may make sense, and then just weigh the consequences of each action. One, you have total control over everything. The other, you're leaving it in control of the of your former employer, and you know odds are those employers are going to still be here in 10, 20, 30 years. But again, you're running the risk of, leaving it in someone else's control, that something bad could happen down the road. How about your entry into Medicare? You may enroll in it at medicare.gov within a window of your 65th birthday. That is beginning 3 months prior to your birthday and ending 3 months after it. If you sign up before your birthday, you will be covered beginning on your first day, the first day of your birthday month. Sign up following your 65th birthday, and you may have to wait for coverage to begin. If you expect to stay on the job after 65, consider signing up for Medicare Part A, the part that pays for hospital care, within the usual window. It will not cost you anything to do so, and sometimes Part A makes up for shortcomings in employer-sponsored health plans. You can enroll in Part B and other Medicare components later, within 8 months of your retirement, to be precise. You may want to pay attention to that 8-month deadline, as your premiums will jump 10% for every 12-month period afterwards you refrain from enrolling. If you pay for your own insurance, you may still need to enroll in Medicare when you're eligible. All right. Rehearsing for your retirement can be very insightful. Some new retirees leave work abruptly only to have their financial and lifestyle assumptions jarred. As you want to make a smooth retirement transition to a future that corresponds with your expectations, test driving your retirement before it begins is only wise. All right. And the next one here is the behavior gap and your financial health. Excuse me. It turns out my job was not to find great investments, but to help create great investors, end quote, writes Carl Richards, the author of The Behavior Gap. From increasing our budget mindfulness to taking a steadier approach to investing, Richard has drawn attention to how our unexamined behaviors and emotions can be to our detriment when it comes to living a happy and financially sound life. In many cases, we make poor financial decisions when experiencing panic or anxiety due to personal or widespread events. Behavior gap explained. Coined by Richards, the behavior gap refers to the difference between a wise financial decision versus what we decide to do. Many people miss out on the higher returns because of emotionally driven decisions, creating a behavior gap between their low returns and what they could have earned. Excitement when stocks are high. Whether in a bull market or witnessing the hype from a product release, many investors feel tempted to increase their risks or attempt to gain from emerging investments when stocks are high. This can lead to investors constantly readjusting their portfolios as the market experiences upswings. Excuse me. Fear when stocks are low. In response to market volatility, investors may feel they need to choose more secure investments and avoid uncertain and seemingly unsafe investments. When stocks are low, a typical response may be to sell and effectively miss out on potential long-term gains. Short-term anxiety and focus. As humans, viewing aspects of our lives through the lens of current circumstances is normal. However, our emotional response to any event is letting the moment consume us. Many may find it difficult to think long-term and remember. However, making a rash decision can inhibit the long-term benefit of maintaining a balanced perspective without reactionary behavior. The market can go up or go down at any given point, or it can remain the same. One thing we can control is how we handle our financial strategy. Remembering the likelihood of recovery over time and the market's nearly inevitable up and down movement can provide a more logical angle to calm the nerves. If you're experiencing financial anxiety in response to the markets, take a breath and remember the potential for long-term gains. Of course, you can and you should always reach out to your financial professional. Again, I know somebody, give me a ring for further clarification. All right. Let's go ahead and read through today's market recap. Let's see. S&P 500 climbs on tech, consumer strength. Apple unveils a new chip. Ooh, that sounds exciting. The S&P 500 rose Monday as tech climbed and consumer stocks jumped on optimism about China reopening. Tech climbed in choppy trade as investors weighed up signs of easing regulatory crackdown on tech in China against ongoing expectations for Federal Reserve monetary policy tightening. Big tech was mostly higher, led by Alphabet and Amazon, which the latter was up nearly 3% after its 20-for-1 stock split, took effect on Monday. The move is expected to make the stock more attractive to retail investors. Apple, meanwhile, was up less than 1% after the tech giant announced a new iPhone software update and its latest chip, the M2. Ahead of the event, investors were eagerly anticipating clues on the company's AR and VR, augmented reality and virtual reality technology, which, quote, will be a key broadening out of the Apple ecosystem as the company aggressively goes after the metaverse opportunity with Apple Glass, end quote, Wedbush said in a recent note. Twitter, meanwhile, cut some losses after confirming it intended to enforce the $44 billion take-private deal with Elon Musk. There's some rumors that he's trying to get out of it. So I don't know. I haven't seen anything about anything concrete about that. In a regulatory filing, Musk threatened to walk away from the deal, alleging that the social media company had materially breached the terms of the deal by failing to provide information about fake accounts and users on its platform. I personally think he's just using that as leverage to get a more fair price. If far more than the 5% of fake accounts that they claim are closer to 20, 30, 40%. He's going to want a lower price on that deal. So I don't blame him on that. So like I said, I think this is more just posturing and trying to get some leverage. China stocks were also in rally mode, led by DD Global, up more than 35% as reports that Chinese regulators are reportedly ending their probe into the ride-hailing company, fueled optimism that Beijing's crackdown on tech is nearing an end. Consumer stocks were the top-performing sector of the day, with casino stocks doing some of the heavy lifting as investors digested news about a further loosening of COVID-19 lockdown measures in China. Caesars Entertainment, Penn National, and Wynn Resorts gained more than 2%. Energy stocks shrugged off a retreat in oil prices as investors weighed up a recent commitment from OPEC and its allies to increase output. I think we've been hearing that quite a bit for a while now. I'm not sure when they're actually going to get around to actually increasing the output. In deal news, Spirit Airlines surged 7% after JetBlue Airways sweetened its takeover offer for the discount airline. JetBlue raised its breakup fee, the amount paid to Spirit if the deal is blocked by regulators, to $350 million, representing $3.20 per Spirit share. All right. So again, some positive news out there. Oil's down a smidge. I was watching the futures last night or yesterday. They were, I think it was up over $120 a barrel. So anything's an improvement at this point. What is oil sitting at right now? 119, 120. So anyways, all right. Next article I got here comes from my friend John Malden. Never met him. I just like his work. This one's titled "No Soft Landings." It's a pretty long article. I'm only going to hit some of the highlights. So we'll go ahead and jump in about midway. And in here, he's talking about he had a conference about a month ago that he's been going through each week as far as the topics and the subjects that were talked about. So, all right. So this part comes from here. Tom Honig is the person speaking, or is quoted here, and he says, "I think the Fed will push until unemployment starts to rise too sharply. In their opinion, if the unemployment rate starts to rise more than 5% or more, I think they will back off. Now, I hope they find themselves in that circumstance. They will pause and not re-engage quantitative easing or lower interest rates just to get out of the slowdown that is inevitable, given we were starting from 8 to 8.5% inflation almost. And I think if you look at Powell's spring 2019 actions, when the market threw a liquidity tantrum in the reverse repo market and so forth, his inclination will be to step in. It will take a lot of discipline on his part and on the FOMC's part to say, wait a minute, we may pause, but we're not going to stop. We're going to pause in terms of raising interest rates, but we're not going to reduce them, and we're going to have to get through this. And yes, unemployment is going to be higher. But if he doesn't do that and he starts to back away, then we're going to have the 1970s all over again. Start, stop. Inflation goes up, then it comes down. Unemployment rises, therefore they back off. That's what they want to avoid, and that's the danger going forward. So, what he's saying there is, if the first bump in the road that we might feel as as interest rates continue to go up, there's going to be a slowdown. Companies are probably going to start laying off people because their income is not going to be able to meet their needs. So they're going to have to cut expenses, and payroll is one of them. If you remember from in the last week, Elon Musk has talked about reducing his staff by about 10%. And so I wouldn't be surprised. It's going to be a few months, and employment is typically a lagging indicator. The companies are going to have to start feeling it in their wallets first before they start making those sort of decisions. Now, some might be proactive, like Mr. Musk is doing with Tesla, but I think for the most part, a lot of folks will just wait and see. They'll wait to the last minute, and then they'll cut a lot of their staff. All right, jumping back in, a lot to unpack there. Tom noted the inevitable tension in the Fed's mandate. It's supposed to pursue both price stability and full employment. The unemployment rate stands at 3.6% right now. If 5% is what the Fed considers too high, they still have room to act. There are plenty of job openings, although this week's ADT numbers showed small businesses significantly reducing their new hires, and some actually laying off workers. The Fed can put a damper on growth and sees inflation responds. That seems to be the plan right now. But if growth declines enough to create 5% unemployment, what do you think markets will be doing? It won't be pretty. Between politicians yelling about lost jobs and investors upset about falling asset prices, the Fed will get heavy pressure to change course. Tom Hoenig, having been there, pointed out the Fed has intermediate options. It can pause tightening without actually changing direction. That might be a reasonable choice too. He said the danger comes if they look reactive. They can't get into a start-stop pattern. They need to stamp out inflation first, then deal with the damage later. Whether they will do it that way remains to be seen. Felix Zulauf was more pessimistic. He thinks the Powell Fed is quite different from the Volcker Fed from the late 70s and early 80s. And it's not just because of personalities. It's a different situation and different financial zeitgeist. He doesn't think the Fed or any other central bank can get in the way of imposing the kind of pain Volcker did, and will stop as soon as this year. Then Bill White, in his quiet, studious way, dropped the real bombshell. David Bosson mentioned to Bill White that the Fed will be looking not only at unemployment and the stock market, but also the credit markets for signals. Bill agreed and noted the banks are weaker than we may think. Then he said this, quote, "My real worry on the downside is that it may be that the fragilities are so great at the moment that a moderate degree of tightening will in fact spark a downturn of such a magnitude that even the Fed does back off, that there's not much that can be done about it, and that will have a downward momentum. That we really won't be able to handle," end quote. Bill then elaborated on what will happen when the Fed hits these fragilities. It will back off, and then, quote, "all that does is generate another asset price boom, another upward surge in inflation, and then eventually they will have to turn on it. It is just making the underlying fundamentals worse, and then things collapse, and it's even worse. So at this juncture, I'm really worried about future debt inflation, and sooner rather than later. And I don't think we're prepared for it. We're not prepared for it in terms of public psychology, and we're not prepared in terms of the facilities that we've got, not just in the US, but perhaps more importantly, worldwide, to deal with the degree of debt restructuring that's got to come out of a deep debt inflation problem. We don't have either the administrative means, or for that matter, we don't have any principles about sovereign restructuring to guide restructuring. He said that so calmly, I suspect the audience wasn't sufficiently terrified. The only thing worse than out of control inflation is the idea of out of control debt deflation. And Bill is worried about it sooner rather than later. That should leave you shaking in your boots. Let me explain why. Inflation isn't great, but it has a silver lining. It favors debtors by letting them repay their loans with cheaper money. A few years of moderate inflation might have helped everyone reduce their leverage. Far better not to have accrued so much debt in the first place, but it is where we are. Deflation does the opposite, making debt payments repayment harder. That would be a guaranteed global crisis. Many overextended debtors, especially emerging market corporations with dollar-denominated debt, would be unable to pay, probably including some governments. Then what? Bill White, one of a handful of our, I'm sorry, one of a handful on our planet who will have the answer if one exists. So we aren't ready for it. All right. So that's, basically what they're talking about here is, we are in a position, where we painted ourselves into this corner where, we have to go through the pain of getting inflation down under control. Because if we don't, we're going to eventually lead to a situation where we have, stagflation like we had in the 70s, where, it just makes it harder and harder to pay things off because, anyways, it's just a big mess right now. All righty. Next article I got here, or last one I'll go through. No hurricane yet. This comes from our friends at First Trust, Brian Westbury. And he's referring to Jamie Dimon's comments from last week. JP Morgan CEO Jamie Dimon caused a stir lately when he talked about a hurricane hitting the U.S. economy. We think he may eventually be right, but is way too early. The unemployment report for May confirmed that the U.S. economy continues to grow. Both major measures of jobs went up in May. Non-farm payroll rose 390,000, while civilian employment increased 321,000. Total hours worked expanded 3%. Has a recession already started? Certainly not. Notably, there is some evidence of a transition in the economy from goods towards services. Retail payrolls are still up from where they were pre-COVID, but dropped 61,000 in May. With the exception of the initial onset of COVID-related lockdowns in 2020, that's the steepest drop for any month since 2009. Meanwhile, jobs in leisure and hospitality increased 84,000, the 17th consecutive monthly gain. In turn, this fits with recent activity on the stock market, where companies that specialize in retail goods have suffered relative to those like theaters and airlines, which provide services. More people want to be out and about and getting back towards normal. The worst part of the jobs report was for wages, where average hourly earnings rose 0.3%. In a normal economy, a 0.3% gain would be perfectly fine. But with consumer prices up an estimated 0.7% in May, that's no bueno for workers. So basically, you're losing 40 basis points because your earnings are only going up 0.3, prices go up 0.7. The funny part is that some politicians are now trying to take credit for job growth. The president says he's created 600,000, quote, new manufacturing jobs, for example. It's true that it is nearly how much manufacturing jobs are up since January of 2021, but total manufacturing jobs are still 17,000 below the pre-COVID peak. Politicians want to take credit for good news and blame others for bad news. We are forced to take data at face value with no political point of view. The economy is still climbing out of the COVID lockdown hole. That means jobs will grow in 2022 in spite of the Fed raising rates. In spite of this problem, consumer cash flow and balance sheets remain healthy. The financial obligations ratio finished 2021 at 14%. That's the share of consumers' after-tax incomes they need to use on debt obligations. Ooh, hear that thunder? That's the debt obligations like mortgage payments and car loans, as well as recurring payments such as property taxes, homeowners insurance, and car lease payments. To put that in perspective, from 1980, when the data start, to the end of 2019, the ratio was never lower than 14.7%. Meanwhile, household net worth finished up last year at more than 8 times annual after-tax income, the highest ratio on record. Americans had 1.2 trillion in checkable deposits and currency before COVID. At year end of 2021, they had 4.1 trillion. The bottom line is that loose money from the Federal Reserve has inflated everything. Moreover, monetary policy remains loose, and the lag between loose money and the economy is long and variable. Put it all together, and it means that some sort of hurricane is on the radar, but it's not very close. So, and I would agree with Mr. Westbury. I don't think it's on the horizon today, but it's getting close there. So I would, again, now's the time to build your bunker and be careful. All right. Last thing I got here is a audio podcast. It comes from the Bob Murphy Show. Mr. Murphy is a economist, and I think he's a professor at Auburn. He does a lot of different things, and Real smart guy. First half of this podcast has to do with his thoughts on the Libertarian National Convention that was held in Reno or I guess 2 weeks ago, by the time you watch this. And but second half has to do with what the Fed's doing, and he's got some really good insights there. So we're going to take a couple of minutes and just listen to Mr. Murphy, and then we'll be finished for the day. So let's go ahead and get this started.
In business cycle theory. Like normally in Austrian business cycle theory, we say, oh, the Fed causes an unsustainable boom with cheap money, flooding the market with credit that doesn't represent genuine savings, and that pushes down interest rates to artificially low levels. And then when things start overheating, the banks chicken out and they begin tightening, and then so they suck money out of the system and interest rates go up. And then in the tight money regime, a lot of enterprises fail, and that's the bust. Right? So that's kind of the quick and dirty version of it, of Austrian business cycle theory. So then the question is, well, wait a minute, what if the Fed starts tightening, not by sucking money out of the system, but just by paying banks a higher interest rate? So that does raise market interest rates, right? Especially short-term ones. But is that really the same thing as tightening if the amount of money has not been reduced? Right? So that's an interesting theoretical question that I'm not fully satisfied one way or the other on. But we can certainly ask the question and answer it in terms of the mechanics. So yes, the federal funds rate had been gently rising over time under Yellen and Powell, right? I'm just forgetting exactly when Powell came in. But certainly throughout 2018, 2019, the federal funds rate kept getting raised periodically, and it had gotten up to 2.4% by the summer of 2019. Then they cut, looks like August of 2019. They cut again in September. They cut again in November. Then going into 2020, and then in March 2020, they started drastically cutting it because of coronavirus panic. And then after that, it was at basically zero. It was, hovering above zero for a long time. And then they finally raised it in March. So it went from, I'm looking at the effective federal funds rate, like the actual market rate. So it was at 0.08% as of March 16th, 2022. And then going into early April, it was up to 0.33. And then in early May, it jumped up to 0.83. And as of May 26th, which is the last date that I have here, it's at 0.83%. Okay, so you could say, well, in a sense, the Fed has raised extremely short-term rates from 0.08% in mid-March to 0.83% in late May. So that's something, right? And yeah, it is. But when you ask, okay, what's happening to price inflation? Okay, so that's nominal interest rates. But what if price inflation is raging so much that actually the real interest rate is dropping? Okay, so Mises has a discussion about this, that apparently in interwar Germany, a lot of economists, when they were trying to understand, like, why is the currency collapsing, the German mark, why was it collapsing with incredible rates of price inflation? And apparently some economists thought, well, it couldn't be the Reich Bank's policies. It couldn't be monetary inflation causing it, because look, they have interest rates are at historically high levels. Look how high their interest rate is. So that's a very tight policy. So what the heck's happening? And Mises' point was, well, no, I'm making these numbers up, but it's like if prices are rising at 1,000% a month and the central bank raises interest rates from 5% up to 100% in an annual rate, that might seem like incredible tightening, but not if prices are going up 1,000% a month. Because in real terms, then that's still like negative interest rates. You're still borrowing when prices are a certain level, and then the marks that you're paying back the loan with a year later are worth basically nothing. And so you have to have a nominal interest rate that was really high just to match the price inflation, let alone any sort of real component on top of that. All right, so in a highly price inflationary environment, just because nominal interest rates start moving up a little bit, so yeah, that's tightening relative to not moving them up. But to say overall, is money becoming tighter, if you're using the interest rate as a sign, an indicator, the real interest rate is probably more relevant than the nominal one. All right, so there's that element. And then in particular, though, if we want to ask, is the Fed tightening a sign of an impending recession? Like, are they tightening enough that they're going to tip the economy into recession? The answer, as of when I gave that talk in Orlando, was no. It was going the wrong way. And so here's in particular what I mean. I looked at the yield curve, specifically the 10-year Treasury constant maturity yield minus the 3-month Treasury constant maturity yield. And that's the best indicator of when we say the inverted yield curve, quote, predicts recession. So by the way, I can't get into it right now. I've already gone long on this episode. I just want to finish this point. I'll wrap up. But if you don't know what I'm talking about, or you vaguely have heard those terms, but you never saw it spelled out, again, my Understanding Money Mechanics book, I have a whole chapter on this stuff. Okay, so check it out. But there's this relationship that says if the 10-year yield minus the 3-month yield, that's typically positive, right? Because normally the yields on 10-year treasuries are higher than on 3-month treasuries. The intuition being, if you're going to lend your money to the government for 10 years, you want a higher interest rate than if it's just a real short-term loan. Okay. However, in certain circumstances, for whatever reason, the yield on the 3-month is higher than the yield on the 10-year. And that's when it's called an inverted yield curve. And it just so happens, going back to World War II, every time the yield curve defined in that way inverts, within 8 to 18 months or so, there's a recession. And going the other way, every time there's been a recession since World War II, there has been a prior inversion of the yield curve. Okay, so if you correctly define this metric, it has no false positives and no false negatives in terms of, quote, predicting an impending recession. And so when the Fed began tightening, at least according to the financial press, I just assumed that the yield curve was going to be flattening, meaning going from positive to approaching zero and then flipping. And in fact, the 10-year, 2-year spread briefly did go negative a few weeks ago, or at this point, more than a month probably. But that particular measure doesn't have as much predictive success as the 10-year and the 3-month. And so I checked the 10-year and the 3-month, and that spread was increasing up through May 6th. That spread was higher in May 6th than it had been going back years. And then since May 6th, it started coming down pretty fast. Okay, so it's still, as of May 25th, 2022, the 10-year, 3-month spread is still 1.69 percentage points. So still.
All right, we'll go ahead and stop that there. Like I said, I would skip through the first half where he's talking about the Libertarian conference. If you're not a Libertarian like me, you probably don't care. But, the second half of the video or the audio is fantastic. Like I said, give it a listen. Mr. Murphy is really, really smart, and he's someone that I listen to. And so he's talking about the yield curve right there, where right now, based upon the metrics he's looking at, it hasn't inverted it yet. However, that spread is going to shrink quite a bit, I imagine, over the next couple of weeks and months. And we'll just continue to pay attention to it and see where it goes. But again, there's not a lot of good news out there. I mean, there are some day-to-day, short-term, little bits that seem good. But again, now's the time. If you're, if you're Noah, build your ark, because bad things are going to happen potentially here in the near future. So, anyways, all right. Well, that's everything I had for today. I know I went a little long. Had a bunch of extra material I wanted to cover that I had gone through over the weekend, and I thought I'd want to share that with you guys. So, all right. Well, hope everyone has a fantastical evening. And I'll be back tomorrow with the Liberty Call. And if anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And have a great evening, guys.